got it. Thanks, Whitney. I'm Asher Jacobs, here with Jade Hu from Columbia Business School, and we'd like to acknowledge our teammate Rana Prinajali, who unfortunately was unable to attend today's event. We're presenting a short thesis on Stericycle with a price target of $38, presenting 36% downside over the next 18 months. Our thesis is threefold. One, we believe that the fallout from Stericycle's recent class action settlement over its pricing tactics is still in the early innings and will continue to drive revenue and margin declines. Two, with 4 turns of leverage and high short-term cash requirements, Stericycle will be unable to continue its roll-up strategy in the coming years. And 3, we note numerous accounting red flags that highlight Stericycle's deteriorating fundamentals that should concern investors. So quick background on the company. Stericycle was founded in 1989 and has since grown through nearly 500 acquisitions. The company historically has focused on the medical waste market. It's been a leader with around 70 to 80% market share in that space. And in the medical waste, so say for example, you go to the doctor's office or a hospital, the doctor and nurse will take a syringe or other medical waste, dispose of it in the red trash bin or red box on the wall. Stericycle will come in and dispose of that medical waste appropriately. Customers are divided into 2 buckets, LQ and SQ. LQ are large quantity medical waste generators, such as hospitals or other large facilities. They offer lower margins, but it's been Stericycle's bread and butter. The Stericycle's focus has been on the SQ, or small quantity medical waste generator, say small doctor's offices or small clinics, which offer much higher margins, and that's been Stericycle's focus. And throughout our presentation, we'll be focusing primarily on this SQ business and the headwinds the company's been facing. More recently, in the past few years, Stericycle has expanded its offerings, its compliance offerings, to shredding through its 2015 acquisition of Shred-it, environmental and hazardous waste, and communication services, which include answering services for doctors, lawyers, and other professionals, call centers, and recall-related services. As you can see, the focus is the domestic, small quantity, regulated medical waste, which constitutes around 25% of revenue, yet more than 40% of EBITDA.
Thanks, Asher. So in the past, this is a company that has grown through acquisitions to build a 70% market share in SQ medical waste business. Its pricing is at least 30% higher than its competitors, and in the past has managed to increase pricing up to 18% biannually. Its contract length is usually 5 years long with very limited flexibility. However, going forward, we expect its ability to increase pricing to be capped at 5% annually. They will have to price match to the competitors given increasing competitive threat, and their contract length will be shortened to 3 years due to increasing competitive tension as well. As a result, their margin is expected to go down. In addition, their balance sheet will be too stretched to make further acquisitions, which is what they have relied on historically. So you might be wondering, what has prompted this deterioration in the business? In 2015, a lawsuit was filed against the company for its pricing increase of up to 18% biannually. Last year in October, a settlement of $295 million was reached and has brought Stericycle's price gouging mechanism to the forefront. Our research shows that the Stericycle has staffed its retention department at a record level to stop customers from leaving the firm. However, per our conversations with 5 different private players in the market, the competition is heavily spending on marketing to win over Stericycle's customers. So the key takeaway from this slide is that the impact of this lawsuit is much more than the $295 million, but it has prevented Stericycle from increasing its pricing going forward. So we also did a price comparison of Stericycle and close to 20 of its competitors in 4 different cities. As we have highlighted, Stericycle is priced at a premium of 50 to 100% in these markets. We want to bring to your attention that there has been a major shift in its business philosophy to allow more flexibility in its pricing and also the contract terms. However, even with the new pricing, their prices are at a substantially higher level than its competitors, which means that for older contracts, those contracts are priced at a much higher level and would have more room to drop pricing. As a result, we expect the SQ revenue to decline by 7%, primarily driven by its inability to raise pricing going forward. This is in sharp contrast to the 10% pricing increase they've had in the past. On the volume side, we also expect volume to go down by 7%, which is actually less severe than before, as the company is aggressively making price concessions to retain and gain new customers. However, given the high fixed cost structure this business has, the 7% decline in revenue will translate into 14% decline in EBITDA. In addition, the healthcare industry has been going through consolidation, which has shrunk the customer base for SQ, the most profitable business for Stericycle. As you can see in this chart, the percentage of physicians that are employees for large hospital groups have increased from 42% to 47% since 2012. As a result, the SQ EBITDA contribution has declined by 20%. So this is showing a very important factor that has led to margin erosion in this business. Our second thesis is that non-core acquisitions, usually value disruptive, have led to lower margins, ROICs, and have left the business with a very strained balance sheet. Take the $2.1 billion Shredded acquisition, for example. This is a cyclical business in a cyclically declining industry. There's limited economy of scale between the core medical waste business and the paper shredding business. And we also expect the recycling margin to come down as the recycled paper pricing comes off its cyclical peak. So essentially what's going on here is a mix shift to lower margin and ROIC businesses. A bit more on the background again. So this company that has been built on acquisitions, this is how it has gained its market share and premium pricing in the SQ segment. However, going forward, we expect it to be really difficult for them to continue its roll-up strategy. Its net leverage to 4x right now has $750 million obligations due in the next 2 years. Their credit rating was recently downgraded, which speaks to the kind of balance sheet stress they're going through. They also have $1.2 billion debt due by 2020, which is currently only paying 2 to 3% interest rate. We expect that to go up significantly when they have to refinance that debt. Lastly, they were close to trip their covenant earlier this year until they got a waiver from its lender through the end of 2019.
Thanks, Jade. Our third thesis is the numerous accounting red flags that highlight Stericycle's deteriorating fundamentals. There's a lot on this slide, but we wanted to highlight is the fact that allowance for doubtful accounts has tripled over the past 2 years and is more than 3 times that of peers. Useful lives of customer relationships has halved over the past 4 years. And what's alarming here is that over the course of its 500 acquisitions, Stericycle is essentially paying a premium for these customer acquisitions. So it's concerning that the value, the useful life of these customer acquisitions has halved. But what's most striking is a growing delta between GAAP and adjusted EPS as management continues to add back certain line items to EPS. All the while, free cash flow conversion as a percentage of adjusted EPS continues to decline. The one thing bulls and bears do agree on with regard to Stericycle is management. After 4 years and more than $3 billion of acquisitions, $5 billion of equity value has been destroyed. We believe management is focused on empire building at the expense of shareholders. Incentives for management are primarily tied to absolute adjusted EBITDA, which drives this desire to build an empire. The only ones to benefit are management themselves. As you see, their base compensation has increased as return on invested capital has declined. What's striking here is a lack of insider ownership by management, as you see in the bottom right chart. Despite the relatively long tenure with the firm, there's practically no ownership. So this slide quantifies our research and analysis. And just to point out on the bottom chart, that shows our varying perspective relative to consensus 2020 EBITDA. While we're forecasting revenue declines, our big delta here is EBITDA. So what's happening is that revenue will be declining because of the SQ headwinds. But as the revenue shifts from the SQ, from the medical waste segment to shredding, that decline in margin is going to hit the total blended margin, which the company does not disclose segment-by-segment operating margins. So we believe that's what the street is missing. They're taking the current margin blended and using that as a run rate. We believe that's going to continue declining. So how do we see this playing out over the next 12 to 18 months? We expect continued earnings misses, beginning with Q1 earnings release, which should be in around an hour, but it's more over the next 12 to 18 months. On top of that, we expect large asset impairment, considering the fact that more than 70% of the company's assets are intangibles, and there hasn't been a material impairment despite useful lives of these intangibles halving over the past few years. We also wouldn't be surprised by continued earnings restatement and even an SEC investigation of the company's accounting policies, considering the fact that the SEC has persistently been questioning Stericycle's accounting policies in recent years. Key risks to our thesis are an activist investor getting involved and pushing for a breakup of the company with the different segments that it has gotten itself into. Janet Partners did make an attempt to do that in 2016, but exited shortly after. We spoke to an analyst who worked on that investment and are comfortable that at current valuations, it would be difficult to break up the company, as the shredding, the hazardous and environmental waste would receive a much lower multiple on EBITDA, and that would mean that the medical waste business would inherently be getting a higher multiple, which it wouldn't deserve with the high pricing headwinds that it's facing. The company actually announced last week that it's looking to sell its communication segment, and it's expected only to receive a single-digit multiple, which is below current valuation. So we see that as a boost to our thesis that the company currently is over-earning and the valuation should come down. Second key risk is Waste Management or another competitor or strategic acquiring Stericycle in an attempt to enter the medical waste industry. We spoke to numerous industry experts and former waste management executives and believe that with Waste Management's focus on stable revenue growth and prudent capital allocation, Stericycle would be too risky of an acquisition in terms of valuation and the headwinds it's facing. Our base case assumes a 9.5 times EV to EBITDA multiple on 2020 EBITDA. So it's a forward multiple, which brings us to a price around $38 a share, presenting 36% downside from current prices. What we find compelling here is that even if we're wrong, and management could hit the high end of 2018 guidance, and revenue and margins stabilize going forward, and using an industry high multiple of 11 times forward EBITDA still only brings us to a price below $70 a share, which is less than 20% upside. So that presents a bear bull risk reward case of nearly 4 to 1, which we view as quite compelling. So to sum it up, while bulls believe that Stericycle is a value play with its pricing pressure behind it, and they believe that after a 50 to 60% drop in the stock price, it's an attractive investment, we believe with intensifying competition, a high fixed cost structure, high leverage, weak management, and accounting issues, Stericycle still has room to go down and is a compelling short to get on the way down. Thank you very much.